Well, here we are, your startup tax questions answered. Good morning, good afternoon, good evening, everyone, or from wherever you're joining us from, whether you're in Dubai or in Oahu or San Francisco. We're tuning in from San Francisco, California. Pilot is a San Francisco-based company, hence why we're here. I'm joined today by my co-pilot, David Kelm, and we're here to answer very commonly asked questions about startup taxes. You're probably here because some of the questions you might have some questions about startup taxes and how to figure out who you should work with, the things that you really should be considering when you're deciding who your provider is, and then we're here to help you as much as possible with that. But quick disclaimer is that this webinar really is just for general information purposes only. Nothing in this presentation really is or should be taken as legal, tax, or accounting advice. The reason for that is because every business is different and taxes are rather complex. So just a quick note on that. Okay, so again, thank you for joining. Just a quick introduction for myself. My name is Justin Wiguna. I'm a product manager at Pilot. I oversee our tax product and also work on our customer experience products. And before Pilot, I actually was a co-founder of a CPG business where we sold on e-commerce, but also did nationwide distribution in supermarkets and outdoor stores. For as far as Pilot goes, Pilot powers the financial back office for startups and SMBs. We specialize in bookkeeping, tax, and CFO services, and really aim to provide exceptional quality deliverables and service to our customers. This is super key to us because I think it can really be transformational for your business to make your financial back office work, not just as a compliance lever, but as a way for your company to grow. As mentioned before, I'm joined today by David Kelm, a good friend, good co-pilot of ours, our business tax services manager. David, do you mind giving a little bit of intro of yourself?
Yeah, definitely. Thanks, Justin, for that introduction. As Justin said, my name's David, and it's actually my 1-year anniversary at Pilot today, so very exciting. Before Pilot, I worked in the public accounting sector at not one of the big four, but a top 10 firm. So my background's in corporate tax, mostly with financial services companies and in the community banking sector, but also worked with some fintech companies and sort of had a good background just with the tax preparation process as a whole and other special projects. And it's been great sort of making the transition to Pilot and getting to sort of help these startup-based customers we have and help them navigate the tax jungle, to say. But yeah, Justin, that's a quick introduction on me. I'll let it go back to you.
Awesome. Thank you, David. I think Dave was being a little humble. He's such an expert on taxes, been helping our customers a ton throughout all of last year, and I think he's been such an asset to Pilot. So we really appreciate him joining. He's bringing in a lot of knowledge from his years of experience. And with that, I did want to cover a little bit of common questions about more of the administrative aspects of taxes. So not quite about the taxes themselves, but things like what do you look for in a tax provider before we hand it off to David for some other common technical questions. So as far as what do you look for in a tax provider, I think this is really relevant right now because we're just kicking off the tax season. The classic way people really choose a provider is that they look for a provider based off of a recommendation from someone they know. This is how I found my original provider when I was running my business. We asked a friend, he was actually the founder of Boba Guys, for who's your accountant, and we actually worked with him. Usually, people ask for an accountant or a tax provider from a similar industry, and this is really helpful for the selection process because it helps you make sure that whoever you choose understands the business that you're in. Every business is slightly different. The industry is different. The growth stages are different. And it's really important for your tax accountant to understand that so that they can optimize the savings that you might have or at the very least, make sure that your business continues to be compliant throughout the year. At Pilot, we get most of our customers based on referral from other people who had a really great experience with us so far. So personally, I agree with this approach. It tends to lend itself to good results and ultimately good compliance. But the main thing you want to make sure you have is someone who can answer questions related to your business domain. So whether you're a SaaS startup, you're a CPG business, maybe you're e-commerce, or maybe you're an agency or a professional services provider, you want to be looking for a tax accountant who understands each of those industries, because the way they operate are completely different from each other, and you might see different results based off of that. So a quick example is you might have a company that is looking to get the qualified small business stock. So it's really key to have a provider who can answer all of the subsequent questions for that might arise, so that you can take advantage of that as much as possible. So on the next slides, I want to walk you through a few questions you should ask of your provider when you're looking for one, and a few ways you can be best prepared to work with them once you actually sign the contract. So some common questions you should ask your provider is, do they have experience working with similar companies to mine? So we talked about industry already. You also want to be looking at the growth stage. Do they have experience? If you're a 10-person company, do they have experience with that? Because someone who working with the 10-person company is very different from working with, say, a $100 million company. So you want to look at that. What does their typical client look like, and does it look like you? This is not literally like, does it look like you, but does the business profile look like yours? Do you think the business model is similar? Do you think you're in a similar stage? Typically, if they have a lot of clients that are similar to your business, it might be a good fit. Do they have familiarity with specialized tax credits, specifically R&D or the employee retention credit? These are programs that the federal government has put in place to help businesses grow and claim credits against their expenses. And it's relatively new within the last decade, so it's important. You want to ask your tax provider to know if they have that experience and if they can take advantage of those claims for you. Do they work with my bookkeeper? Or maybe another question to this is, how do they work with bookkeepers? The bookkeeper to tax accountant relationship is really important, because ultimately the taxes will be filed based off of the books. So if your tax accountant has questions, they need access to your bookkeeper, and ideally your bookkeeper is super responsive to them so that they can continue continue working on your filings so that they're ultimately on time. What is their communication style? I think this applies to not just tax accountants. This really applies to really anyone you work with. You want to work with someone who has a similar communication style, or at least compatible communication style to you or whoever might be working with them. This will just make it much smoother when you're trying to get things done, and when you run into an issue, it will make it easier to overcome those issues. And then, can they help me with an audit? Audits are certainly scary. It might seem like they'll never happen to you, but I can tell you that they do happen. So what really matters in an audit is that you can provide the evidence for the returns that you filed. Ultimately, this is on you as a business, but an experienced tax professional can help you with that, especially if they did your taxes with good due diligence. So next, we want to talk a little bit about how to really be prepared when it comes to working with a tax provider. First of all, working with a tax provider is not truly set it and forget it in most cases. So you really want to make yourself available to answer any questions. Some things you might expect and should expect is that you might expect your tax provider to ask you for authorization for payments. If you're actually making tax payments, you'll need to sign the tax return. So at the very least, that's what they'll need from you. And they'll likely ask you for information about your business that they don't necessarily have access to. Something like, who are your shareholders, information about your shareholders if they have 20% or more. Secondly, you'll need your prior year tax returns. It's common practice to use prior year tax returns as like the starting base of information about your business, because if any of that information changes, for example, your entity type, that needs to be officially filed for. And if your tax accountant needs to know that so that they can file the right filings. You want accurate books. This really is based off of the quality of your bookkeeper and how engaged you've been with your bookkeeper, because similar to tax accountants, bookkeepers don't have all the information. So ultimately, once you get to the end of your fiscal year, your books should be accurate and ready to hand off to your tax preparer. And lastly, be ready to review and sign off. I recommend anytime your tax preparer sends you a draft return, give it a read. It might not necessarily make full sense to you, but you'll be able to pinpoint some of the key financials like your net income or potentially shareholders or equity distributions. And that's super important to keep an eye on. From my own personal experience in the past, a tax preparer had put down the wrong entity type, and we were able to catch it because we actually looked at the tax return. So don't assume it's going to be right. Ultimately, you are responsible for your return. So make sure you review it when working with your tax preparer. All right. With that said, I think we have this working. All right. I skipped a bunch of these slides I was supposed to go through. All right. Now, with that said, we'll pass it on to David to cover a handful of the key questions that we see oftentimes from our customers and prospects and whatnot. Let me find that slide. Boom. One second. Okay. So we'll start off with a new topic in the last since COVID, because a lot of employees moving around. This is something that we get a lot of questions about, and this is something that affects the tax return quite heavily. But this is one of the first topics we'll cover. So, David, can you share a little bit about how do remote employees affect your tax filing obligations as a business?
Thanks, Justin. Yeah, so like Justin said, with COVID and everything, remote hiring or remote employees have become a lot more common, and hiring these remote employees can definitely affect your business in terms of your state income tax obligations. Uh, Historically, maybe we've seen a company that's based in California really just filed their federal tax return, then they file their California tax return and they call it a day. But if they're hiring a ton of remote employees, sometimes we see their state filings increase from 5 additional states in addition to California, and sometimes in the most extreme cases, we've seen it get into the 20s. So definitely something to keep in mind if you're hiring remote employees. Generally, once you have a new sort of remote employee working in a state, you're required to file payroll tax returns for that customer or for your employee, where the applicable sort of state tax needs to be withheld on their wages. And sort of what filing the payroll taxes can do is it opens up the company to income tax exposure, as sort of having physical presence with that employee working there and filing payroll taxes. It can put you on the state's radar for income tax filing itself. And while it's not common, as every state's different, there's 50 states, and unfortunately, each state has their own different rules. But with the more complex or sophisticated states, we see sometimes that they can put sort of two and two together, where they're like, "Hey, wait a second, you're filing a payroll tax return in our state, but you're not filing an income tax return." Not super common, but we have seen it where states can be super aggressive in terms of income tax filings in states. So that's why it's just important to uh, take into account where you're hiring your employees, and at the end of the day, deciding if you want to sort of do business or have exposure in that state at the end of the day. Like I said, every state's different, unfortunately, but a few states are making it a little more clear, where they have this thing called a bright line nexus test, where sort of if, for example, in California, if your payroll exceeded $69,015 in 2022, then California says, okay, you exceeded the $69,000 limit, then you just automatically start filing tax returns there. So it is a little bit nicer that some states are sort of making it clear, where if you exceed a certain dollar amount, then you should go ahead and file. Unfortunately, every state's different, and each year it changes. So we continue to keep an eye on it and inform our prospects and customers as these rules and laws do change. But yeah, Justin, I think that's a high level in terms of remote employees. If you want to move on to the next question.
Awesome. Thank you, David. The next question is actually about 1099s, but there's kind of a follow-up in the chat that I think might be worth addressing from David Chen. He asked, can I avoid filing an additional state tax by issuing a 1099 instead of a W-2?
That's a great question. So it would depend on sort of the nature of the relationship with this individual. We've seen companies get in trouble in the past for sort of miscategorizing their employee as a contractor to kind of get around the taxes. So we'd recommend that you seek an advisor to just make sure that the facts and circumstances are accurate there, where they can in fact be treated as a contractor, and you don't sort of get a slap on the wrist for miscategorizing them.
Yeah, I can speak from experience that 1099s or W-2s can get kind of dicey. There are a lot of rules around what you can label as a contractor. I think there's a lot of official ways to get around them, but like David said, you should definitely talk to someone before actually making that decision. Okay, great. Thanks, David. Next question. Also related to contractors. If your contractors live in a different country and you pay them more than $600 each in the year 2022, are they obligated to complete a W-9 and for the company to send them a 1099?
Yeah, that's a really great question. And the reason for the $600, as Justin mentioned, is that's sort of the threshold for a 1099 filing. Once you exceed that $600, then generally your contractor is subject to a 1099. And in the case of international contractors, luckily they're not required to complete a W-9 and sort of fill out the 1099 form. And super high level, Form W-9 is something you'd send to a new US-based contractor you're working with, just so you get their needed name, entity type, business address, and social security number, because that's sort of the baseline of what is included on the 1099 form itself. But as stated, luckily, international contractors are not subject to the W-9 and 1099 filing. That being said, they are subject to a different form that's called W-8BEN, and that form should be sent to your international contractors as you start working with them, just so you have that documentation in your records. And generally, if Form W-8BEN is not filled out for this international contractor, the wages paid to them should be withheld for federal tax purposes at 30%. And that's sort of the IRS getting their piece of this sort of international payment or income. Luckily, with Form W-8BEN, there's probably around 70 to 80 countries today that the U.S. partners with. They're called U.S. tax treaty benefits, where there's a sort of an allowance where this 30% rate can be reduced down from 30% or exempted altogether, which is very beneficial. And the U.S. does this to avoid the double taxation, where, say for example, you're an international contractor in Canada and you make contractor money there. Basically, you fill out Form W-8BEN and claim the tax treaty benefits with Canada, and that'll exempt them from withholding the 30% for U.S. tax purposes. That being said, on the form, you have to promise that while we're not subject to the 30% withholding in the US, you're sort of promising that you'll pay the applicable Canadian tax on those payments you received from the US company. And yeah, as stated, the goal is just to avoid that double taxation and make it more friendly for US companies to work with these other countries and their skilled labor.
That one's pretty complicated.
It can be, yeah. Luckily, with Form W-8BEN, it's only a one-page form where a bulk of the form is just filling out their personal information, and then you list the country you're claiming the treaty benefits from, and then the IRS has good guidance out there on the list of countries where the tax treaties do exist. And one last item to note with this is if the contractor isn't an individual, or maybe it's actually a business entity that's located overseas, there's a slightly different form that has to be filled out, and that's called W-8BEN-E for entity. This form's a little more involved. It's a multi-pager, but again, with that one, you can claim the treaty benefits there if they exist. And one last item to note, some of the misconceptions we see is generally Form 1099 needs to be submitted to the IRS, but Form W-8BEN or BENE, they don't need to be submitted to the IRS. They really just need to be kept in the company's records in the event the IRS requests a Form W-8 from the company. That being said, we haven't run into any instances where a company has received this request from the IRS, but I'm sure maybe there's someone out there that has received that request, as there's always a possibility the IRS comes knocking. Other than that, I think that's all we had related to Form W-9 and international contractors.
So just to kind of summarize to make sure, because there's a lot to that. If you have a foreign contractor, you need to collect the W-8 bin or the W-8 bin E, and to keep
That's
that
right.
on file. But there's not technically anything you have to file because of that. There's no taxes you have to pay for that specifically in those countries. You just have to make sure you have it.
That's correct. Yep, nothing's required to be actually submitted with the IRS.
Okay. All right, great. Last question in regard to remote employees. What states and jurisdictions do I need to file in, and how is that determined?
Yeah, that's a great question, and sort of related to the first question we went over with sort of state income tax compliance. And at a high level, it would depend where your company has payroll, property, or is making sales. And sort of as a general good rule of thumb, if you have an employee working in a state, you should file income tax returns in the state, as there's the potential for the state to chase you for your income tax filing if you're already filing payroll taxes in the state. Uh, Going back to the state of California, specifically, they have kind of a two-pronged approach to sort of requiring income tax filings. If you're a California-based company and you register with the Secretary of State, generally the state will give you a corporation number if you're a corporation, or a LLC number if you're an LLC. And sort of what happens there is then you're sort of in the state system and on their radar. So if you don't file your taxes for that year, the state will send you a letter and demand that you file income taxes. The second prong, as sort of stated in the first question, is there's a bright line nexus test with California, where with payroll, if you exceed that $69,000 amount, or your payroll is 25% or more of the company's total payroll, that would require you to file a return in California for the year. Same deal with property in California. They have the same threshold of that $69,000. And sort of what property is if you have computers or fixed assets in the state, that would go into your property total. If you rent office space, the rent expense goes into that property total. So that can add up quite quickly if you are renting in California. And the last prong is if your sales in California exceed $690,144, that also would require an income tax return in California. One nice thing about California is they do index these numbers each year for inflation. Uh, the baseline for some of the states is much lower, where they say if you have over $50,000 in payroll, you have to file, or $500,000 in sales. So it is nice that California does index this for inflation each year, given the sort of rising inflation we're seeing across the nation. And very quickly, some other common states we see with some of our customers and prospects are New York State and the state of Texas. These states are also on the list of ones that are now employing a bright line nexus test. And in the state of New York, luckily their threshold is much higher. So say you don't have any employees working in New York, but you're making sales in New York, the threshold is $1 million in New York sales. Once you pass that $1 million mark, you should be filing in New York, but it is nice that that threshold is much higher than most of the other states. With the state of Texas, it is lower, unfortunately. So if you surpass $500,000 in sales in Texas for a given year, you should be filing a Texas income tax return. But high level, that's sort of how to determine what states and jurisdictions to file in, just keeping in mind where your company has payroll, property, or you're making the sales themselves.
Thanks, David. I think that it makes a lot of sense that it matters for each state. And as far as other jurisdictions, say cities, are there any particular cities that kind of follow a similar guideline where you might have to file specifically in that city as a result of you doing business there?
Yeah, one that comes to mind would be our home city, San Francisco. Luckily, with San Francisco, they changed the law recently where if you have under $2 million in San Francisco gross receipts, then you don't have to file a San Francisco tax return. So we see it very rare with our customer base where they actually have to file a San Francisco tax return. Uh, that being said, if you are conducting business in San Francisco, you do have to file for a business registration and renew that each year, but that's much less involved than having to actually file a income tax return itself with San Francisco.
Yeah, I think one thing, and correct me if you don't agree with this. I think one thing too, in terms of like as a business owner, how should I think about this? Typically, if you do business in any kind of city, county, or state, if you have employees there, if you have sales there, or if you have property there, you should be checking with your tax accountant to see if you need to file there. Or rather, if your tax accountant is good, they should be checking with you and telling you that you do need to file there. But it's a team sport, I should say. So it's helpful to be aware that if I have employees working in New York City, even though my business is based in Las Vegas, I probably have to file in New York City. So I think that's how I think about it. There's many like complicated rules that are different for each jurisdiction, as David had mentioned, but that's probably a simple way, a way to simplify it for your thinking.
Yeah, definitely agree, Justin, that yeah, the best policy is just to have an open dialogue with your tax provider to ensure, like you said, it's a team sport that the needed filings get done.
Yeah, and we share this so that when you actually go and do your taxes, it's not a complete surprise if you have remote employees in all 50 states that you might have to file in all 50 states. So it's something to be aware of, especially for our new business owners. This is not something I certainly did not know when I started my business. All right, I think that covers the remote employee section. Just if you guys have more questions, feel free to post it in the Q&A. At the end, if we have the time, then we'll try to address the ones as much as possible. But for now, moving on to the next section, which hopefully is helpful to folks, is the R&D tax credits. So there's a lot of talk. There's been a lot of talk about the R&D tax credits. As mentioned before, this is a way to claim credits. There's been a lot of talk because there was supposed to be some new legislation coming through. But David, can you actually just share a little bit more about and go into detail about the new R&D legislation change for this year?
Definitely. So prior to the 2022 tax year, companies you could just expense 100% of any research and development or R&D expenses and the year that they were incurred on your income tax return. And that was pretty preferential because companies with high R&D spend, you can just expense those expenses for tax purposes and claim those deductions on your tax return. Unfortunately, after the 2021 tax year, so beginning with the 2022 tax year, there's a sort of law change that's kind of floating out there still, where uh, these expenses you can't 100% expense in the year they're incurred, but instead they have to be amortized over 5 years if they're domestic based expenses, and then over 15 years if they're international expenses. And sort of alluding to what Justin said, where it's a potential new law change and it's kind of out there, is the Congress was supposed to sort of come together the last 6 months to either postpone this uh, sort of law from coming into play or repeal it altogether, because this will definitely affect sort of research and development based companies where they won't be as incentivized to sort of do the R&D expensing and sort of activities, as these expenses are not able to be fully captured in the year they're incurred. Um, and it had been long sort of believed that Congress would repeal this. Unfortunately, in the negotiations and the various bills they're working through, this sort of fell through the wayside. There is still some hope that this could be retroactively repealed, but the further we get into 2023, the harder and harder it gets to sort of be retroactively repealed. So that's why we want to sort of talk about this law change at a high level. And sort of as mentioned, where the expenses, if they're US based, have to be amortized over 5 years, and internationally over 15 years. There's a section of the tax code, it's called Section 174, and that sort of governs your R&D expenses, which include the following: indirect and indirect expenses. in terms of indirect expenses, the most common, or sorry, with direct expenses, the most common ones we generally see are wages. These could be your wages paid to your full-time employees who are working on research and development activities, or they could be wages that you're paying to contract employees who are devoting their time to research and development activities. So any direct sort of wages paid to your full-time employees or contractors would have to be capitalized over 5 years or 15 years if they're based abroad. On the indirect element, it gets even more complex where, say Justin is working on R&D activities for half of his time, but then the other half of the time he's not working on R&D activities. Luckily, with 50% he's working on non-R&D activities, those can be expensed 100%. But for that 50% related to R&D activities, those would have to be amortized over 5 years rather than expensed in the year that they are incurred in the past. So it gets very complex, unfortunately, and we're seeing more companies use international contractors, just given the wide sort of array of talent around the world nowadays. So that would negatively affect companies that are using international contractors for their R&D activities, as those wages would have to be capitalized over 15 years. Other sort of direct expenses we commonly see related to R&D are the actual materials, direct materials that are being used. It could be software development tools, your sort of R&D lab expenses and supplies, and even obtaining a patent for your R&D process that you're working on. Those would all be considered R&D expenses. As mentioned again with the indirect expenses, this includes overhead. So if you have a research and development facility, or you have depreciation related to your R&D equipment, unfortunately that would have to be capitalized as well. One example of that would be if you rent a space and maybe 25% of that space is related to R&D activities, then you'd have to bifurcate 25% of your rent to be capitalized over 5 years. So it gets very complex, and it's putting a lot of administrative burden on companies and their accountants in the event that this doesn't get sort of repealed or fixed in Congress. And sort of lastly, related to what these expenses could entail, it's very broad. So it could be developing a specific process or formula, computer software, or the technique itself. So with all that said, like, what does that mean for me as a business? This law change does have the sort of potential to trigger a company that's historically been a loss into a taxable income position if your R&D spend is high enough for the year, because in the past you've enjoyed that 100% expensing in the year it's incurred, but now these expenses have to be spread either over 5 years or 15 years. One thing to note is if you're a pre-revenue company, you wouldn't be affected by this change, as you would still be in a taxable loss or break-even position. Assuming in the most extreme case that all your expenses are non-deductible, you'd still be at a break-even point. And if you're at a break-even point or a loss position, then you don't owe any federal income taxes. But yeah, this is definitely something we're continuing to monitor and hoping that Congress will sort of fix this so that these R&D based companies can continue these sort of tax benefits related to the innovation and time and effort they're putting into that.
And David, can you? I realize we didn't quite explain what the R&D tax credits are. It's just like in like a 30-second explanation. Can you share with this group what the R&D tax credit is and how it can be beneficial for the businesses?
Definitely. So yeah, the R&D or research and development tax credit, as Justin mentioned, it's a relatively new tax credit, sort of enacted within the last 10 years. And what companies can do is if they have qualifying R&D expenses, they can sort of report these expenses on their tax return itself, and you receive credits related to these R&D activities. And there's one of two ways that these credits can be claimed. Historically, companies could claim these credits dollar for dollar against any income tax liability they have on their return. And then if they're not able to utilize the credit in the year it's incurred, they can carry that credit forward up to 20 years. we don't see this too commonly with our customers, as some of them are pre-revenue or not generating any profit yet. So luckily, within the last few years, the IRS issued another sort of law change where there's another way to claim this credit. And rather than claiming this credit against your income taxes, you can actually credit it against the employer portion of your Social Security taxes related to your payroll taxes. So we found that to be very beneficial for our customers. While they can't use it against income tax, they can actually receive some cash savings against their payroll taxes.
Yeah, the R&D credit is a way essentially for startups to get money back. And I think this is really relevant, especially in the downturn of the market today, where businesses are cash strapped, where layoffs are happening, and people are just looking for ways to trim the fat as much as possible. One thing you can do is try to claim your R&D tax credits, assuming you have qualifying R&D expenses. One thing that in the Goldcast app, there's a doc section, and one of the docs is a guide to the R&D tax credit. I'll also link it in the chat. I think this should work. You can take a look at, read through it. I recommend folks who have any sense that they're doing R&D activities to read through this to figure out if this actually makes sense for your business. And it is something that Pilot does, but it's a way that you can get money back from the government so that you can extend your runway. So I have a couple kind of specific questions for you, David, around the R&D tax credit. So if I started my company in 2022 and we're still pre-revenue, as in we're not making any money, can we still claim the R&D tax credit?
That's a great question. Yeah, so even if you're pre-revenue or not generating any money yet, as long as Justin mentioned, you have qualifying R&D expenses, you're still able to claim those credits.
Cool. So it works for companies that are not making money yet. And then a follow-up to that is a subsidiary company eligible for R&D tax credits if the software development happens in another country?
Yeah, that's a great question, and definitely one we're seeing more nowadays, just with the prevalence of sort of international subsidiaries and international contractors. Unfortunately, any sort of software development or wages paid to contractors in foreign country aren't eligible for the R&D tax credit, as the R&D tax credit is more of a US based tax credit, and the IRS is trying to incentivize sort of US based R&D activities. So yeah, in short, uh, subsidiary company that's located overseas, any software development or wages would not be eligible for the R&D tax credit, and only US based software development or wages paid, assuming they're qualifying expenses under sort of the R&D guidelines on the credit.
So the R&D activities have to essentially happen in the United States.
To claim the credit. Yep, that's
And the
correct.
credit, yeah. Okay, let's go ahead and move on to the next section, which kind of focuses on pre-revenue companies. This is a lot of new startups are not making money yet, but it doesn't mean you don't have any tax obligations. So in this section, we'll cover like what are the things that you should be aware of if you are a pre-revenue company. So the first question here is, do I need to file taxes for employees even if the company doesn't generate income? I think this probably has to do with payroll taxes.
Yeah, it sounds like this deals more with payroll tax. But that being said, you still need to file payroll tax returns for your employees, even if you're not generating any income. And the reason for that is the IRS and applicable state or cities where your employees are working, the sort of tax needs to be withheld on their wages. So to sort of be compliant with the IRS. And if you have a payroll provider today, then they can typically work with you to get this squared away and keep you compliant with any payroll tax filings related to your employees. From an income tax perspective, which is more pilots focused, uh, you're still required to file income tax returns with the IRS and sort of applicable states you're operating in, even if you didn't generate any income or if you're in a net loss position. Uh, Even though you're not paying the IRS or states any tax, they still do want to see your activities for the business for a year. So once the business starts operating or is incorporated, you generally have to keep filing tax returns until the business shuts down in terms of a compliance standpoint there. And it's definitely a common question we've seen where companies, they kind of fall into this trap where they'll file one year when they made money and then other years they didn't file when they didn't make money. So as a good rule of thumb, you want to keep filing tax returns for every year that you're in business from an IRS perspective. There is a way to sort of trim the fat from a state tax perspective. If, for example, you were operating in California and then all your employees left California and you're not making any sales or have any property in California, that's definitely something you want to bring up to your tax provider and let them know that, we're not doing any more business in California. And is it possible for us to file a final tax return with California and sort of close down our account there? That's definitely something we'd recommend. And it all comes back to just having an open dialogue with your tax preparer to make sure they're aware of these changes in your business.
Yeah, I think one thing you mentioned, for every year you're in business, you need to be filing tax returns. This includes if your business dissolves, if it's no longer in business, there still needs to be a final tax return filed. And typically that's like I believe 4.5 months after the due date is about 4.5 months after the dissolution date. Is that correct, David?
Yeah, so it'd be 2.5 months if you're a LLC or flow through entity, such as an S corp or partnership, and then 3.5 months for C corporations. So say you shut down on December 31st, then you would have to file a tax return by April 15th if you're a C corporation. Luckily, you're allowed a 6-month extension as long as you file that extension on or for April 15th. If there's still items you need to sort of address to get the tax return completed.
Yeah, I think that's something that is not necessarily common knowledge, but worth noting because it changes the schedule in which you might be thinking about taxes. If your company is dissolved, for example, if you're acquired, hopefully the acquirer will actually take care of the taxes for you. But something to note. Well, one thing that we kind of talked about is payroll tax versus income tax, and my understanding is that they are different kind of activities, typically done by different providers. David, do you mind sharing just a little bit about that, like, and how that works and how the two are different from each other?
Yeah, definitely. So payroll tax is a different facet from income tax. Payroll tax is what you submit to the IRS in states you're operating in, where you say you paid your employees X amount of compensation, and then you have to withhold that compensation at the applicable federal and state tax rates. Whereas for income tax, you report the operations of the business as a whole, and then the the corporation, if you're a corporation, would pay any tax on those profits of the business. But yeah, definitely different facets of tax. There's companies that strictly specialize in payroll tax, and Pilot's focus is more on the income tax side rather than the payroll tax side.
Yeah, if you're using something like Gusto, Rippling, or JustWorks, typically they take care of the payroll taxes for you as part of their offering. Okay, next question. If net income was a loss this year, do we get an income tax credit that we can apply for future years?
That's another great question, and definitely one we see pretty frequently. So when a company's in a taxable loss position for the year on your tax return, the company gets what's called a net operating loss, or NOL. And for these NOLs incurred in the 2020 tax year and beyond, they can be carried forward indefinitely and eventually used once the company is in a taxable income position. The only item to note for these 2020 and beyond NOLs is you can only use up to 80% of that NOL to offset taxable income. So, assuming you can utilize all 80% of that NOL, you still have 20% taxable income exposure there. If you're a business that's been around before 2020, the limitation luckily doesn't apply. So if you have 2019 net operating losses, those can be used to offset up to 100% of your taxable income. The only item to note with that is those NOLs do expire after 20 years, whereas 2020 and beyond NOLs are able to be used indefinitely and there's no expiration on them. But yeah, definitely net operating losses are very helpful for companies where if they've historically been in a loss and then once they reach profitability, they get to use these prior year losses to help relieve some of the tax burden that they experience once they're in profitability.
All right, thank you for that, David. I think we have one final section, which is really just a general question section. General. Great. Slightly broader questions, and this one is related to entity types, and I think entity types play a huge role in how how your business is affected by taxes. But more specifically, how much do tax filings change from an LLC to a C corp entity?
Yeah, so we see all sorts of different types of business entities here at Pilot. So if you're an LLC, you file something that's called Form 1065 with the IRS, whereas the C corp files a slightly different form, which is Form 1120. That's sort of high level. At a very high level, the LLC and C corp file different forms with the IRS. Some see LLC filings as more complex, as each member in the LLC needs to be allocated the proper ratio of profit and losses each year. And those profit and losses then go on something called Schedule K1 at the end of the tax return. With C corporation tax returns, there's no Schedule K1, so that's part of the reason why some people see LLC tax filings as more complex. Also, again, beginning with the 2020 tax year, the sort of reporting requirements for LLCs increased, where the tax capital account of each LLC member has to be tracked year over year, and it can't go into negative balances. So this has created a big administrative burden on LLC businesses and their accountants, tax accountants, as they have to track these capital accounts year over year and keep a close eye on them. From a mechanical perspective, with the federal income tax returns, the LLC itself doesn't pay any tax, and then any income deductions or credits are passed through to the members themselves. And then the members themselves would take that Schedule K1 to file their own income tax returns. As stated for C corporations, they don't have the Schedule K1 element, and some people see this as an easier entity type to fundraise, just given the legal structure of a C corporation. And lastly, the C corporation pays tax itself on any net income, and the net income tax sort of payment requirement doesn't fall through to the shareholders as with an LLC. But yeah, that's high level, sort of the different elements of an LLC versus C corp tax filing.
Thank you, David. Uh, we are starting to run short on time, so I'll just go on to my next question. What do I do if I want to change my entity type or fiscal year, and how does this affect my taxes?
Yeah, this is another common area we see. Sometimes an entity starts off as a LLC, for example, and then they convert to a C corp. Changing your entity type can definitely be something that makes sense for the company. But if you do want to change, you should definitely consult legal counsel or an attorney that specializes in entity conversions, as there's needed documents, as Justin mentioned earlier, that need to be filed related to the conversion. And you want to ensure that you have a compliant entity type or conversion change so the IRS doesn't keep sending you notices down the line. Uh, One item to note is it would complicate your tax filings for the year if, for example, you convert from a LLC to a corporation in the middle of the year. So, say on July 1st, you convert from an LLC to corporation. Assuming you're on a calendar year end, then you would have two tax filing obligations for that tax year. The first tax year would be from January 1st through July 1st for the LLC return. And then after that, you would have a July 2nd through December 31st filing for the C corporation. So that definitely complicates your filing requirements for the year if it's a mid-year conversion. There is a way to sort of get around that, and with anything, planning and open communication with your provider is the key to that, where if you schedule this conversion ahead of time and sort of make it take place on December 31st, then you would just file a full LLC tax return, and then your C corp tax return would begin on January 1st of next year. So we've been able to see some companies do that and sort of hit it just right, which is nice. So they don't have to file 2 tax returns for 1 year. And that's sort of just changing your entity type at a high level. If you want to change your tax year or fiscal year end, this also requires a decent amount of planning. And sort of what needs to be filed with the IRS is Form 1128. And generally, we recommend that a company keep a calendar year end, just as a lot of the IRS due dates are based on calendar year end companies. And the only reason really to change your tax year end is if you have an underlying business reason to change, as it can complicate the income tax process. Also, some planning needs to go into account, as Form 1128 can only be filed in a certain window for each tax year. So, for example, if you want to change from a December 31st year end to a January 31st year end, you would only be able to do that for the 2023 tax year. And that would have to be filed between a very certain window of February 1st, 2023 and May 15th, 2023. And that being said, if you wanted to sort of retroactively do it for the 2022 tax year, it would be too late, as that very slim 3.5 month window had already closed. But yeah, just at a high level, that's how to change entity type or fiscal year. Best policy is just good planning and having an open dialogue with your accountant or provider to make sure the needed forms are filed.
Yeah, one thing on the more of the administrative side, when deciding if you want to change your entity type and when to do it, David mentioned try to change it, or I don't want to say it's a recommendation, but if you change it at the end of your account of your tax year, then you don't have to file 2 tax returns. One implication of having to file 2 tax returns is that typically tax firms will file per tax return. So if you did do that, you would be paying double to your tax accountant as a result. So again, it's really important to keep an open dialogue with your tax preparer, so that they understand what's going on and they can recommend the best path forward. All right, I think we have one last question before we can answer hopefully just 1 or 2 Q&A questions. As far as state and local nexus goes, how do you reduce notices and interest and penalties? Um, this is really one comment I'll make here is that it's really stressful whenever you receive uh, a letter from the IRS labeled IRS and you open it and you don't know what it is. Sometimes it's a penalty, sometimes it's something that needs to be addressed. So this is really looking at how do you make sure that doesn't happen.
Yeah, big focus on today's webinar was just state income tax. So again, to reiterate, the best way to avoid it is just track where your company has employees working, where your property is located, and where your sales are located, and just having an open dialogue. If for example, in 2022 you uh, made sales or hired an employee in the state of Oregon, for example, just to let your tax provider know that you have presence in Oregon now, and they'll take that information and file an Oregon tax return for you, or sort of look at the facts and circumstances to see if an Oregon filing is in fact necessary for you. And generally you want to do that by April 15th, as that's the original due date for state tax returns for the most part. If you don't file by April 15th, or if you don't file an extension by April 15th, then that's like when Justin said, you'll get hit with those notices or interest and penalties for late filing. Because if you come later in the year, maybe in the summer, you realize you didn't file in Oregon and you're already past that due date, then the state will likely send you sort of a late filing notice. Usually these notices aren't too high in dollar amount, but as Justin said, no one wants to receive a letter from the IRS or a state sort of demanding them to pay money or take action on that. But at the end of the day, yeah, just keeping track of where all your business activities are occurring, and having an open dialogue with your tax provider will sort of ensure that you file the needed tax returns and avoid those notices and interest and penalties.
Okay, great. That wraps up the common questions that we had prepared. I think we have time for 2 questions from the Q&A. The first one is from Justine Hong. Can you talk about tax implications of things like internet, cell phone reimbursements for more remote employees or office setup stipends?
Definitely. So those expenses would be deductible to your company. If you're a corporation, for example, something to keep in mind is those expenses generally aren't subject to tax on your employee's W-2 as long as you have a reimbursement policy in place where the companies or the employees required to submit receipts and sort of substantiate those expenses.
Okay, and then we have the last question from JP. For startups incorporated as C Corps in Delaware and selling software online for US and international customers, for example, like marketplace, transaction fees, SaaS, what are the standard income taxes before reaching profitability? Are there any taxes applicable to revenue regardless of profit? And does that change if the company is incorporated in Delaware but headquartered in another state, such as California?
Yeah, in this case, so really quick with the state of Delaware, luckily they don't have an income tax return, but there is an annual report you have to file each year. Uh, most smaller companies, they only owe the minimum tax of $450 with Delaware. That being said, in California, you'd probably also have a California filing requirement. Um, and then in terms of sales to other countries and states, it would depend on the dollar amount of those sales. If those sales are getting into the high dollar amounts, then that would definitely possibly trigger an income tax filing requirement in those states.
Okay, awesome. Thanks so much for that, David. Uh, Thank you for sharing your expert knowledge, David, with everyone on this webinar with some of the more complex tax questions. Hopefully, this has been really helpful for folks to at least, at a minimum, know what to look out for when working on taxes and when working or looking for a tax accountant. Just as an FYI, if you do have more questions, Tax Pilot does have a tax consulting service available where we can consult and officially advise on tax-related matters specific to your business. If you are interested in that, you can email us at info@pilot.com. Also, we have a couple of docs available in the doc section of this webinar where you can access blog articles about how to find the right tax preparers, what you need to understand about taxes, and you can look through that to learn more about what you might not already know about tax returns. Thank you again for joining. As Jade mentioned in the chat, if you had a Q&A question that we didn't have the time to get to, we'll follow up on it post-event. But again, thanks everyone for joining, and we hope you have a good rest of your Wednesday morning, evening, or afternoon. All right, I think that wraps it up. Bye, everyone.
Thank you.